Welcome to Club E. Hi, I'm Rick Brimacombe of Brimacombe and Associates. I am your architect of business growth, and I'll work with you to unlock the potential and amplify the scale of your company. Today, we're talking a professional investor's perspective on the market's volatility and what their likely structural changes are going to be to our economy and industries. Before we get to our session, I want to thank our sponsors. Irish Titan is an e-commerce and web development firm. Goulet Group, CPAs and advisors. Highland Bank, a family-owned community bank. Romaine Berg, a digital marketing agency. Minnesota Sales, a sales acceleration firm. And the Network Connect, a catalytic gateway for growing your company. Before we get started, I'd like to remind everybody to please subscribe to our Club E channel. We need your help, and I'm going to give you a little moment here, so I'll pause, let you hit the subscribe and like button. They're right below the video. It's going to help us better deliver content to you, our wonderful audience. All right, so a little technical difficulty. I have to say I'm doing this from Brimacombe headquarters up north. Thought we could make this happen. I'm still assuming that we can, so we'll give it another try. So I'd like to again introduce our speakers, Thomas Paulson and Patrick Mulvehill. How are you guys?
Beautiful.
Doing great.
Happy to meet you.
And Thomas and Patrick, you're joining us both from Minneapolis today.
South Minneapolis.
That's correct.
All right. Well, welcome. And for those of you out there who'd like to connect with Thomas and Patrick, their contact information will be in the comments field, and you can get it there. Also want to remind everybody that that they can ask questions. We'll get to that in a moment. But first, Thomas, why don't we start with you, and then we'll hit Patrick up. Tell us a little bit about yourself, your background, and the firm.
Yeah, so I've been a professional investor for the last almost 19 years after a period of entrepreneurship where we met, and I was your first employee. And after business school, I ended up working for a very large investment team at a company called Alliance Capital, where we invested in public equities. Any given position would be somewhere around $4 to $5 billion. And so we were one of the initial investors in the public markets in eBay and in Google and many, many other companies. That experience transitioned to another company that was based in Edina, Minnesota, did a similar thing called Cornerstone Capital, but not quite as large. And that firm had good success, lasted for about 10 years, ran into a little bit of difficulty at the end of that. And I then stepped up and created my own Inflection Capital to more or less do the same large company public investing. So I might see myself really as an industry analyst and a professional investor, generally in companies that serve the consumer. That can be anything from the Targets to the Best Buys to Molson Coors or Delta Airlines or U.S. Bank. So it's a pretty broad swath of the consumer economy, which is over 50% of our economy, not including the government and healthcare.
All right.
And I also had the good privilege of working with Patrick Mulvehill at Cornerstone. So that's how we know each other.
All right. All right. So we got a lot of long-term ties. Well, thank you for joining us, Thomas. Appreciate that.
Yep. Thanks. Pleasure. Thanks for the invitation and the opportunity.
Yep. And Patrick, tell us a little bit about yourself, your firm, and the various activities that you're up to.
Sure. So as Thomas mentioned, I worked with him for a couple of years at Cornerstone prior to the closing of that company. After that, transitioned with a previous business partner. We launched a long short fund. Did that for a couple years. After that, we decided to go our separate ways, transitioned Baztec Capital into a structure to manage a local family office. Have been doing that since early 2019, and am now just getting ready to launch a new product, a long short hedge fund focused mainly on small and mid cap stocks that would be open to external investors.
Okay, great. Well, thank you for joining us. Appreciate it. Say, before we get to our event, let's tell you, the audience, what you can receive for your participation today. First of all, again, you can get Patrick and Thomas's email addresses in the comments field, as well as submit your questions. And with your question, type in #investing, and we're going to pick a winner to receive a gift certificate from Clancy's Meats and Fish in Linden Hills, a fan favorite here at Club E and with Thomas and Patrick. So Clancy's, we're just trying to help out a local establishment, whether you're buying some meat or fish or getting some sandwiches. So again, #investing for your questions, as well as add any comments that you'd like and get into the drawing for the Clancy's gift certificate. All right, so just to get started, if we look back a little over 2 months now, back to March timeframe, what do you think happened from your perspective, and what were you thinking when it was going on? So Thomas, why don't we start with you?
Yeah, I'd say, what's happened in March, and really almost in a little bit of a way here on the back end of it in the reverse way in May, was really, I think, a heavy cocktail of the rational, the irrational, and the technical. And I think also, in my opinion, it was probably the true black swan experience of my career. Like other people have said, like the .com or the housing bust were black swans. I think both of those were relatively well anticipated. It was really the timing that was the unknown. And also from a perspective, I mean, this black swan really happened at a period where the economy was accelerating, where investor expectations were rising, where the S&P earnings or valuation was at 19 and a half times forward earnings. Normally it's around 14 to 16 times. So the market was really frothy when this really, crisis or black swan hit. And so that's partly explains why there's such a severity in terms of the drop down. And so in terms of like the rational, in terms of what happened during this period, from an investment theory tells us that when there's a significant increase in economic and social uncertainty, risk premiums for assets or risk premiums for equities rise, which it did, and that lowers the asset price. And then also from the point of rationale, it was rational for older investors who might need to tap their investments for, over the next 24 months to sell, because if you go back and look at market history and look at the great crash, the Dow Jones Industrial Average went up to $375 in early 29. And then as the economy slowed down, that average went down to 235. So that was a pretty severe drop down. And people would say, well, okay, that was the bottom, because then the market went on to rally another 30%. However, then going through 31 and 32, that index went down under 50 during 1932. So you went from 375 to under 50. So, when you need liquidity, if you're drawing from your from your investments to, live off, it's totally rational to sell at a period of that. And I think from a perspective of technical, during the, the heightened point in March, it was really dispassionate, what I'd say, index selling. There was risk management. There was tightened financial liquidity concerns, and really kind of what I say is buyer strike. And I can identify buyer strikes when I see like Pepsi move down 14% during a day when there's no news, there's just no buyers. So for me, that became an opportunity to really buy what I thought some high quality companies that were disproportionately dislocated, if you will, in the market. And so when I'm investing and I'm making these choices, I'm looking at opportunities really in terms of what's the long-term impact of COVID-19, or in investment terms, what's happening to the terminal value. So, in some cases that's going down, some it's not being changed, in others it's increasing. So in the case of outcome from COVID-19 was that cloud computing just got an enormous boost from the demand for more agility and work from home. And so for me, that meant buying Microsoft for its 365 and its cloud services. So that's kind of what was going through my head and what I was watching.
Well, a lot of action, a lot of turmoil, that's for sure. I want to come back with some follow-on questions to that, but before we do that, Patrick, tell us a little bit about kind of what was going through your mind, and as you're watching the stock prices just free fall, what was your take on what happened in March?
Yeah, what I'll add beyond what Thomas has shared is March was a really scary time, and it was interesting that a lot of people in the financial markets, we were all paying attention to COVID in January, and certainly into February, and everyone was maybe unsure of what that impact would be, but we weren't seeing any follow through in asset prices. And I think if we're all honest, we got lulled into a false sense of security by that. And then all of a sudden, particularly when COVID started to kind of go into Europe, into Italy, then the problem showed up at our doorstep, and asset prices reflected the economic impact. And the thing that I always like to keep in mind is, investing is a perpetual game. The most important thing is to stay in the game, and in the immediate near term, short term positioning matters most. So what you saw was, managers exiting sectors broadly, whether that's travel, retail, aerospace. There could be some good companies, babies were thrown out with the bathwater, but an investor is going to say, I just need to survive this. I need to hunker down. And that's really what we saw in March. And there's some other technical reasons that we don't need to get into that sort of exasperated that decline. But it was a really scary time. And, there's a lot going on. And, there's that theory that George Soros came up with of reflexivity, where, asset prices can feed into the economy, which then feeds into asset prices. And that's how they deviate from maybe what their equilibrium should be. So it was a really chaotic, crazy time. It's easy now, a couple months removed, to say that there's a lot of bargains, but there's a few companies that I kick myself for not buying. But if I'm honest, I was scared to hit that buy button back in March.
Yep. The one to add on what Patrick just said, you can develop situations where you have negative feedback loops, that reflexivity, and it just perpetuates and spirals downhill. And I think we all have to be tremendously thankful of the segness of the Federal Reserve and Jerome Powell, that really took some extraordinary actions to break those connections and stop those negative downward spirals.
So the next question I want to ask is kind of looking forward over the next 12 months. But before we go there, just to talk a little bit more about what happened in March, and here we sit 2 months later, and the vast majority of the losses have been recovered. And it's hard to know exactly all that's going on, but as you look at the recovery from the bottom in late March to where we're at now, again, before we look out 12 months and talk about that, maybe just talk a little bit about the recovery. Did it come faster than you thought? How do you kind of handicap what has happened since late March, after we took the sledgehammer and busted everything up?
Yeah, well, I'll go first. I mean, so clearly there's industries that were winners, and industries that are losers. Somewhat of that of a ramification of healthcare policy and national protocols. So clearly, technology is a winner. The Nasdaq, the 1 year return on the Nasdaq is plus 29%. The overall S&P is up 8% on a 1 year basis. But the Russell 2000, which measures really mid-sized companies, that's slightly negative. So, or if we look at what's happened year to date, what I call like MFANG, which is Microsoft, Facebook, Amazon, Apple, that's up 15% year to date, versus the remaining 495 companies, they're down 8% in terms of their, but these are really the biggest, well-resourced institutions or entities that are really within our economy. So, the mid-tier companies or the smaller companies or the, leveraged companies. I mean, so, or even the individuals or house. I mean, that market isn't really necessarily a measure of what's going on with the broader economy. They're succeeding, and a lot of other people, they're succeeding because they're displacing other parts of the economy, or they're winning because we're getting more productivity, which is less labor, that kind of thing. So, Patrick, what's your view?
Well, I think, there's no rule in investing or financial economics that says, at this expected growth rate, at this interest rate, a market multiple should be X. Who's to say if a market should trade at 10 times earnings or if it should trade at 25 times earnings? And increasingly, it seems as if we are in an environment that I think is best summed up by the acronym that has come up lately called TINA, which stands for there is no alternative. If you're putting capital to work today in the public markets, you have a 30-year bond that's trading at 130 basis points. If you're looking for investment grade corporate credits, maybe you're earning an additional 150 basis points on that. Depending on how you measure inflation, that's either a negative real rate or maybe it's slightly positive, but it's certainly not something that allows you to compound wealth. So the really only alternative is to allocate capital to the public markets. And as Thomas mentioned, there's been some disparity if you look at the various indices and market cap groups within the market, and the Microsofts, the Amazons of the world, the biggest mega cap companies. I think we can all feel safe putting our capital into these companies from a thematic perspective, and I think that's what you've seen.
Okay. All right. Thanks for the commentary there. So we covered March. We covered kind of the recovery over the last, say, 2 months. So now as you look 12 months out, what does it look like for the consumer, for the economy? Patrick, since we were talking with you last, let's start with you this time.
Yeah, I think it's entirely path dependent. The fiscal stimulus that here to date has seemingly been effective at maintaining the consumer and keeping things functioning as best they can during this time. That expires at the end of July. I think everyone assumes and expects that there will be another round of fiscal relief or stimulus, but it's not a guarantee. So depending on how that outcome goes, that's going to dictate, what the consumer and what the economy looks like in Q3, Q4, and into 2021. So on the one hand, there's this fear that we're going to have a fiscal cliff. We might see a lot more job losses, particularly in higher wage earning groups, more white collar jobs that are lost. There's the fear of automation displacing some manufacturing jobs. So there's a lot of different ways that this could play out. I think the base case right now, until proven different, is you have to assume that the Federal Reserve and the government are going to continue to do their best to sort of provide that bridge loan, so to speak, to the U.S. consumer to allow them to get through this. And then we just have to see what companies look like. Do they bring back all those furloughed workers? Do we see greater job cuts? So until I think we get clarification on that, it's very difficult to say. And it could really go down 1, 2, 3 different paths here.
Thomas, how about you?
Yeah, I mean, what Patrick kind of just alluded to there is, what are the fundamentals in, do we have, the foundation for a solid economy and for a rebound? And unfortunately, I think at this point we don't necessarily have those foundational elements. So to put a couple, pieces of data and a little bit more color on what Patrick talked about today, we got the personal consumption expenditure report. And for the month of April, and that showed some pretty amazing data. And all of this would be on an annual basis or an annualized basis. So in looking from April from March, personal income grew roughly $2 trillion more so income to individuals up 2 trillion, despite a nearly 800 billion decline in wages and salaries from private industries. And that came because we got 3 trillion in additional government transfers. And so those transfers, in combination with a 16% decline in spending, meant that savings went up. The savings rate went up to 33%. We typically have a 6 to 7% savings rate, and so that savings for the month of April is $3,000 per household on a monthly basis. So that's this fiscal policy that is hoping to hold people through this softer period of employment. But unfortunately, I think employment is an area that Patrick touched on, that I also feel a lot of concern, and a lot of other people do concern, particularly the Fed as well. This week we got 2 million in unemployment claims, so that pushes the total to 41 million since February. And then unfortunately, layoffs from large national companies are continue to be high as they implement their layoffs, which they've talked about, but they haven't implemented yet. And so those are, be headwinds coming. Offsetting that would be, some of the opening of the economy. If we look at directly impacted jobs from COVID-19, that was, restaurants, hotels, et cetera, that was about 30 million people. So assuming we can bring maybe back half of that amount over the next 6 weeks as the economy opens, that's still going to probably net out to be 31 million fewer jobs due to COVID. And so if we take it from the perspective pre-COVID, that's a 22% unemployment rate, going through July into September. So pretty big numbers there. And if we look at what the Congressional Budget Office is saying, for the year would be down about 5.6% in employment or in GDP, and unemployment being slightly above 11%. So we still would need to get to the baseline forecast, somewhere from 22% unemployment to 11% unemployment by the end of the year. So that's a lot of demand creation that needs to happen through the second half of this year. And clearly we're seeing, from an economic activity perspective, look a lot of different data, a lot of different metrics. I mean, there definitely is a bottoming going on. So like if you look at credit card data from Chase on a 7-day rolling basis right now, spending on their cards is down 20% year on year through May 22nd. That's though substantially better than the minus 44% that we saw at the end of March. So there's a bottoming, but there's still a heck of a long way to go to get back to anywhere close to a reasonable number from an employment and perspective.
Sure. So we talked again about near term, what happened in March and the recovery, talked about here kind of as we look out over the next half year to a year. What about if we shift and we go kind of to the medium and long term? What changes do you expect to the economy and its associated features, again, as we look out kind of more medium and long term?
Okay, well, just feeding in the theme that I just had, I think so much is really dependent upon demand and employment. And Patrick touched a little bit about this in his earlier comment. But when I listen to earnings calls and companies' commentary, because of COVID's work from home conditions, it really demanded businesses to take processes out of their businesses, take people touch points out of the processes to get work done without workers in place. And to do that, the companies have created efficiencies and productivities and automation. And so I think, unfortunately, we're going to lead to a lot of redundancies due to because of that automation and because of those efficiencies. And so you have a longer period of time where you're going to have a substantial number of workers that are just, there's not going to be the jobs. And so if you go back to look at the last two big periods of unemployment, 2009 and then about 20 years before that, 2009, it took about 2 years to pull the unemployment rate down by 125%. And then the period before that in the 80s, it took 2 years to pull the unemployment rate from its peak point down 250 basis points. And I just said, the baseline expectations are looking for us to go from 20% unemployment down to 11%. Even so, if 11%, still you need to foster a lot of demand to get the economy to be heated, to absorb those people back in the economy. And so to me, that's where my sleepless nights come from.
Patrick, how about you? Medium and long-term economic thoughts?
Yeah, so overall, I don't see this being this cataclysmic change. I think if we're all honest, things change, but they don't. Exponential changes don't happen overnight. It's much more linear. Human beings are creatures of habit, and I think we'll go back to a lot of the pre-COVID habits. I think, to Thomas's point about companies, needing to find efficiencies during this time period of working from home. The thing that I think a lot of people fail to recognize is a lot of projects were already in development prior to the stay-at-home order. It's very easy to take a task that you had already brainstormed and already sort of developed a game plan for, and go execute that while working from home. It's a very different story, to say, okay, let's plan our new product cycle. Companies haven't yet had to do that while their entire team is working remotely if they weren't already set up for that. And the other thing, just on the topic of working from home, I find the sort of contrast between tech companies in particular, who talk a lot about their culture and also talk about how, remote working is the future. I don't know how you can really develop and foster a company culture when all of your workers are spread out in remote. I think there's a financial executive who talked about right now we have a lot of, social capital or worker capital built up in the company because we've all worked together before. But if you're onboarding a new employee and he or she are starting from working from home, that capital is not going to get built up, and that's going to have negative impact. So I think you're going to see companies have more of a hybrid model, but I think the death of commercial real estate, in particular office space, I think that's very overblown. So I would expect over the medium term we revert back to a lot of the behaviors we had before. I think to Thomas's point about long term, automation is certainly coming. I think supply chains are going to get reworked, but I think the important thing is, economies have been getting more productive with their capital and their assets for the last 100 years. And that's always going to result in fewer workers doing a particular task. And those workers, will get reappointed elsewhere. And that's just the way things go. So I think, there might be unemployment longer than people expect, but I'm not too concerned about structural unemployment. I think everyone thought that coming out of 2009, 2010, and it turned out not to be the case.
So you touched on structural changes. Thomas has also talked about a few things, but let's dig into that a little bit. As far as structural changes go, what are you focusing on? And let's start with you, Patrick.
Yeah, I think, the whole, working from home, cloud computing, obviously, if you look at the stock prices of those companies, the horse is out of the barn. So, you're probably not going to generate excess returns by looking at that space. What I think is really interesting, in particular, geopolitically speaking, with some of the saber rattling between the US and China, is there's going to be a change in supply chains, excuse me. Now, I don't know if those are going to get reshored back to North America. They could just get re-domiciled to other places in Asia, such as Vietnam or Bangladesh. But supply chains are going to be impacted by this. Also, I think you're going to see companies hold on to inventory a little bit longer than they would have before. For the last 20 years, we've had just-in-time inventory systems in order to minimize the working capital a company needs to carry. I think that's going to change. So I think what I'm really looking for is, on the technology side, things that help the automation and increase supply chain efficiency, because there's going to be additional costs that arise in a company's supply chain. and they're going to immediately look for ways to offset those costs. So I'm looking for companies that are addressing that problem, whether that's, through hardware or more likely software.
Okay. Thomas, how about you?
Yeah, lots of them. Three that I would highlight is one, I call the passing of the digitally naive. The second one would be the emergence of contactless commerce. And the third really is what I call the reaffirmation that the home is the castle. And what I mean by the passing of the digital naive, there were always, while we had a lot of e-commerce was about 20% of retail, ex grocery and auto. That was really dominated by consumers that were younger than 65 or that were more moderate to affluent consumers. What COVID-19 has really instilled and broken down is those holdouts, the digital naive, like people like my parents who've never bought anything online, I forced them to sign up for Amazon Prime and forced them to learn out how to order groceries from Walmart and go drive in to do their pickup on the curbside pickup. And so, that's a substantial shift that I don't believe has much of a give back to it. So pre-COVID, we were about 20% unemployment. I'm sorry, 20% e-commerce. When we adopt, if those digital naives, continue to remain wise, if you will, now e-commerce will be about 30% of overall retail. Amazon will dominate about 40% of that. But we've also seen the quick adoption of some new retail product offerings or service offering, which is the curbside. So, a year ago, Target really didn't have much for an e-commerce offering, but now they have really a digital commerce offer, either digitally where you drive and have things picked up curbside with them in terms of their drive up offering, or in terms of it being brought to your house through their ship offering. And so that's an amazing transition for a company that's that size to be able to move that quickly. That curbside thing is a big thing. So in terms of Walmart's and Target's e-commerce business for the month of March, if I remember this right, or it was month of April, they were up roughly 300% in terms of their digital offering, and it became 5% or more of their total sales. And this is an offering they didn't have last year. In contrast, one of the most successful retailers, Costco, just reported their results last night. Their business did well. There's definitely, lots of consumable buying going on there, and stocking up and hoarding, if you will. But their business was only, on terms of year-on-year growth, was only up 6% versus 20% at Walmart and Target. And that's really coming from that curbside pickup. So that would be one in terms of that digital naive now embracing, what I call now contactless retail, which is the next topic that I would have. And so I think, today and going in the future, people are not going to want to touch surfaces. They're not going to want to touch screens. Money is really dirty. Ahead of this period of time, still 30% of transactions in America were with cash. And for checks that were less than 10 bucks, that was 50%. And so I expect to see significantly more tap to pay and app-based payments going forward. The retailers haven't yet had the time to implement those technologies. So you go to Home Depot today, you still stupidly have to touch a screen, but over the next, call it 6 months, I see us really moving to contactless commerce. And that's really across the spectrum. So when you go to an event, when you go to a sporting event, you go to a music event, I don't really see tickets really existing. It's going to be all immobile. It's all going to be contactless commerce. And, then the companies will have more data, but this also might be shifting the offerings in terms of when you go to a hotel, you no longer go to the front desk. You simply just go to your room that you got notified that it was your room. Or there won't really necessarily be much for queues because people don't want to be stuck in a queue next to a lot of people. It would be kind of scheduled access to whether to get into a stadium or get into an event or music event and those type of things. And then lastly, in terms of the home has just crushed it so far. Even I saw this recently, this week, Zillow put up stats for Minneapolis. We are now seeing year-on-year listing growth for houses for sale, and we're still seeing year-on-year growth in terms of housing, the average selling price. And Home Depot and Lowe's this month, they're probably running faster than 30% year-on-year growth in terms of that business, and that's because people are investing in and appreciating an asset and in their family's comfort and safety. And I think that is kind of a permanent shift in terms of priorities and where people are willing to put their extra capital.
So if I could just interject, because Thomas and I argue all the time. I think, when I previously said that I don't see this as being a big cataclysmic change, I think a lot of the things that Thomas mentioned, I hear those. I don't necessarily disagree in the near term, but I also think, one of the things that I think has really been hammered home during this period of isolation and stay at home is the satisfaction of being on your iPad and ordering something and having it show up in, maybe it's 2 days. Lately, it's been more like a week. That doesn't compare with going to a cool store and buying that product and holding it in your hands and getting it that day. And I think the death of retail is very over exaggerated. Retail had a problem where they didn't innovate and they didn't invest in the stores. To the extent that this becomes an opportunity for companies and landlords to rethink the retail experience, I almost think that people, are going to be excited, when all the dust settles to get back to their shopping habits previously. And curbside pickup's great. But at the same time, that doesn't really help Target in terms of getting you in the store to, present other, merchandise that you weren't thinking of buying, that now all of a sudden, as you walk through the aisles, you grab, and those tend to be higher margin. So I think there'll be a rethinking of the retail experience, but people want to go out and people want to interact. We don't have much in terms of modern history to point to pandemics, but we all know about the pandemic in 1918 and 1919. And, there's images of people at college football games wearing the masks, but then that disappeared after a few years. And I think that's kind of my base mindset with this, is that we are going to go back to the way we operated before. It's just going to be a little bit different and maybe a little bit improved.
Okay. So just want to remind the audience to submit your questions, do hashtag investing if you'd like to go in the drawing, and then also hit the subscribe and like button to receive notifications for when we go live, as well as updates on other content that we see going forward. So again, please let us know if you have any questions that you'd like for Patrick and Thomas today. All right, so talk a little bit about your thinking on the most impacted industries, things like tourism, travel, obviously restaurants. You've touched on a little bit on the retail side, but Thomas, let's start with you this time.
Yeah. Well, I think Patrick, and I agreed a little, somewhat with what Patrick said in terms of reimagining retail or reimagining restaurants. And, unfortunately, I think, that reimagination might come from a different owner than what is currently occupying those spaces. And that, I think is really, troubling and depressing for an entrepreneur to think of other entrepreneurs, having to let go of their dream and have their dream taken away from them. But, I think, in terms of the, really impacted industries, I mean, we're seeing, again, all the near-term data is that we're bottoming, that we're trying to come up. And then you can see that in terms of companies' commentary and decisions of opening. So Disney World opening in July 11th, Universal Orlando opening June 4th. They'll be opening with a smaller I'm on a visitation and this contactless experience that I mentioned, and they're trialing it. They're opening it and they'll push the envelope a little bit and open up a little bit. So I think, but it will be a longer period of time. I think, restaurants will be a very interesting thing to watch in Minneapolis, because you have a kind of a blend of communities. You have like the communities that I live in, which is Southwest Minneapolis, where we have a fair amount of space. So there's more room if the authorities will allow it for restaurants to flow out into the street and to create more of a separated experience. That's much more problematic for restaurants downtown that are on Washington Avenue, and it's confounding for tight metropolitan areas like New York how those restaurants open, and whether there's how long it's going to take for those businesses to recover. That's really the scenario where you say it's not really going to happen until we get anxieties completely ameliorated, vis-a-vis a vaccine or an antiviral. Airlines, I mean, Minneapolis, again, it's been winters aren't everybody's favorite, but we have a huge benefit in that we live in the middle of the country. So to go to the East Coast or the West Coast, isn't a lot of time. And we've been served tremendously by having a pretty good selection of airlines that, brought affordable fares and brought direct fares. I really fear that, we're going to go from a really a huge smorgasbord, if you will, in the same of choices and options, to really a bit more of a much more limited offering, and so it'll be more expensive, and times and direct flights will be much more inconvenient than they were. And in terms of the travel, I mean, I would agree with Patrick. I mean, I think households and individuals, particularly individuals, are going to want to travel as soon as they can see that the communities that they're going into are operating in a open fashion. T&E, business T&E, I think that's going to take a long time, and that's what the CFOs and companies are saying in terms of the last thing we're going to release is corporate travel. And so paying for the premium sites, paying for the premiums of hotel rooms, where the real high level of profitability and the prior margins were, that's probably going to be 3+ years from now. So that's really a long turnout. So the more consumer exposed names and middle of the country offerings, I think have just a much more easier time operationally wise and business wise to get back towards what was normal for them, whereas the businesses that are really T&E exposed, I feel that that's going to be quite a long duration. And maybe the stock prices recognize that. I haven't looked at specifically the the expectation for the recovery to profitability, and what that means in terms of the stock price. But from a fundamental perspective, I think the duration for a lot of it, particularly on the business exposed side or the enterprise exposed side, is going to be a pretty long workout.
Patrick, tell us from your perspective, these hard histories, tourism, travel, restaurants, retail, those kinds of things. What are your thoughts?
Well, I think on travel and tourism, we all want to get out. Anecdotally, small sample sizes, but the people I talk to, everyone wants to, find out where they can go this summer. They want to be safe, but I think there's a real yearning to kind of get out, particularly as we've all been cooped up in our homes. So I think travel in the near term is going to look different, but I don't think that desire to travel has diminished at all. And with restaurants, it's the same thing with travel. I think the one thing that we don't know is what is the new cost structure for these businesses to service the demand when it comes back. A lot of the restaurants, publicly traded restaurants that have remained open, it's a limited offering. It's mostly takeout or delivery. So we don't really have a financial model to point to that says when dining rooms are back open at 100% capacity, whatever that new capacity limit's going to be, we don't know what that cost structure looks like. So that's to be determined. Unfortunately, I think the the near to, hopefully not medium term, but certainly the near term results from all this is the public companies, the larger private restaurant companies, they're going to be okay. They have the resources to kind of weather the storm. The smaller independent restaurants that we've all come to know and love and enjoy going to get a drink or get a good meal, they're in a tough spot. And I think that's really unfortunate that, the big guys are going to benefit, at their expense. And hopefully this whole thing blows over such that that doesn't happen. But I think if you're trying to, put the highest probability on something, that's the probability. And, as it relates to, travel and T&E, that one I'm a little bit in disagreement with Thomas on. And I know a lot of CFOs and a lot of people, have said that the CEO of American Express said that he expects corporate travel to be impacted for years. But it only takes one lost sale to a competitor who took someone golfing or who, had their annual conference. It only takes one of those for everyone else to fall in line. And I think, if you go back to 2009, when Salesforce was still a relatively small company, they're public, but they were a fraction of the size they are today. They still had Dreamforce in San Francisco, and they spared no expense when some of their competitors were pulling back. And that was a big moment for Salesforce, and that propelled them. And I think everyone understands that. So I think, you're going to have a near-term pullback, but as soon as everyone else starts going back to their prior behavior, to stay competitive, you're going to have to follow suit. So I think, it'd be a much shorter downturn in T&E than maybe what some expect.
Okay.
I think a couple of things, in terms of what Patrick said there, definitely, there could be that competitive factor that would be the upside. In fact, Salesforce.com reported last night and was on Mad Money, and more or less, they said this is their opportunity to go take more shares. So that would be, evidence that worked well for them in the past, and they're going to play that playbook again. In terms of travel and tourism, it's going to look different going forward. It's definitely going to look a lot different this summer. You cannot rent an RV. They are all booked out. They are all at premium prices. Winnebago, which I would have thought, would have been a very dangerous stock to buy, in mid-March, it's back near to its high because they're at 100% capacity in terms of their production right now, given really high demand. As people are reimagining what they do with their family vacation, want to be, have some isolation, but have some control. Really, everybody's looking for control. I want to be able to control my environment. I want to be able to control where I go. And so, RVs have been, unlike 2008, where they just got absolutely decimated, seem to have winning consumer behavior or choice, and their economics are actually prospering versus being unwound by this crisis.
So staying into the theme of travel, I have a question from longtime listener Todd. What's your thought on how long it's going to take for U.S. airline share prices to rebound to January 2020 levels? And what specific U.S. airlines do you think will do best over the medium term, kind of 3 to 5 years?
Patrick, you want to take that, or you want me to go?
Sure. I'll attempt to take that. If I think, it goes without saying that airlines are a tough business. They're certainly the old joke. How do you become a millionaire? You start as a billionaire and you buy an airline. Airlines like United and Delta that, have a major international travel exposure, that's going to be hard hit for a while. So I think if you were forced to own one U.S. carrier, you certainly want to look at Southwest. They have the best balance sheet. If you see an uptick in domestic travel demand, they're going to benefit from that, given their network model. Over in Europe, I think Ryanair is in a tremendous position to capture share, particularly as some of the other low-cost carriers, whether it's Icelandair or WOW in Norway, have gone out of business. So, if you have to choose, you choose those two. I think, probably the safer spot within airlines is you got to look at some of their suppliers, and not necessarily the manufacturers like Boeing, but some of the aerospace suppliers like a HEICO or TransDigm that are selling mission critical parts that, if the plane's flying at 95% load capacity or 50% capacity, they still need the parts that those companies provide. So I think if you're betting on a rebound in air travel, the airlines are certainly a high beta way to do it. But if you're looking for something that, is probably not going to go bankrupt and rip your face off, I look at the aerospace suppliers.
Yeah, I would, concur with how Patrick framed the industry and which participants one would want to play with or invest in the near term. Kind of just goes back to what I had said earlier, where I think the tourism recovery is going to be led by the consumer, and more leisure. There'll be a value element to that, and that would be maybe even a domestic element to that. So that would be the Southwest, the Spirit, and then in terms of our own, it's not a public company, but we have Sun Country here in Minneapolis, which is highly levered to that. And I feel fortunate that that they're here, and that the elements of their business can probably allow them to prosper and to continue to serve our community for years to come, versus being a really heavily levered international carrier with lots of complexity.
All right, that makes sense. So another economic external force here is all the stimulus money. So the feds have just pumped an unbelievable amount of money into the economic system. What are your thoughts on seeing inflation at some point? And if so, how high might it go? Patrick, do you want to start with that?
Sure. I'm actually, my thinking on this has evolved. Maybe about a month ago, started to buy some gold, and then kind of flipped on that, because the more I thought about it, and the historical evidence to date, particularly if you look at Japan and the experience in Europe over the last 10 years, there's been zero correlation between the growth in those central bank balance sheets and inflation. Inflation has proven ever elusive. And I think deflation, or certainly, very low inflation, are the most likely outcomes. I hate to say zero, but the threat of hyperinflation and some of the things that were discussed in 2009, 2010, I'm not concerned about those at all. I think deflation is the bigger concern. I think that's why you see low short-term rates, certainly a subdued long-term rate with the 30-year at 130 basis points. For inflation really to take hold, by definition, we have to have demand that significantly outstrips supply. And the one thing that the last 20, 30 years have proven is that the advances in technology make the production of that supply much more cost efficient. And that I don't see changing. And I don't see a scenario where demand all of a sudden explodes to the upside. So I fail to see why the conditions are present for inflation, aside from sort of the hawkish tone of money printing.
All right, Thomas.
Yeah, going back to one of the acronyms that Patrick gave us, which is the TINA, there is no alternative. I think that for a large amount of the calculation is that the Fed really doesn't have an alternative. And actually today, Jerome Powell was speaking for a private event, or for a public event, because it was webcast, that they're introducing the Main Street Act, which is they have, I think it was around $600 billion to invest to medium-sized companies, even larger companies that can't get capital elsewhere, mainly for the point of trying to preserve the jobs at those companies. So the Federal Reserve is significantly concerned about long-term demand destruction due to high levels of unemployment, and that's having far more weight and precedent in their decision making than concerns that they're pumping too much money into the economy and stimulating breakdown or fostering an inflationary spiral. So, and from my earlier comments, that's what I'm also, highly concerned about.
Okay. As we look to kind of wrap things up here today, again, thank you guys for joining us. Interesting conversation, very valuable given the uncertainty and the economic environment we find ourselves in. As you think about our conversation, if you had to highlight one thing or to leave one kind of parting thought, given your talk today with our audience, what would that be? Thomas, why don't we start with you?
Yeah, I mean, kind of alluded to a couple of things at times. I think we're all very, very fortunate to have, the wisdom that the Federal Reserve and even Congress has exhibited during this period of time. I gave the numbers of what happened during the 1930s and 1920s when we had the Great Depression, and that was really the absence of those factors. And one of the areas I've looked at, over the last 3 months, to kind of give me wisdom and how to think about really scary times that were really horrific and didn't really have strong precedent, was to look at what happened to the UK stock market or what happened to the US stock market during World War II. And there is a wisdom to crowds. So, the wisdoms in crowds, they sniffed out that things were going to get less bad during the Blitz in London. And it was really during the darkest days there that the market found a bottom and then began to never look back. Even though there wasn't great things to, on the future, it was scary times in the future, but the market continued to move higher. And that same happened in the United States with Midway. And so, there's a value in terms of preserving your wealth and growing your wealth, even in really bad economic, social times like we're experiencing. So, all can be scared and all freaked out, but that doesn't necessarily mean you don't want to own equities. My, study of history is, unless you have really bad policy, which we don't have right now, broadly speaking, it's a good, equities are a good preservation of and grower of your capital and of your wealth.
And no other alternatives.
No other alternatives.
Yeah. Hey, Patrick, how about you?
Yeah, I thought that was very well said by Thomas. The only thing I would sort of add is, and I certainly fall prey to this. I'm sure Thomas does from time to time, but it can be very seductive to try and pontificate and opine on the short term and try and say what the next quarter is going to look like for a company. And sometimes we lose sight of the medium and long term. And if you look at sort of the big companies in the US equity markets, Facebook, Netflix, Amazon, investors knew that they were some of the strongest companies out there that had some of the strongest medium to long term growth prospects. And in those darkest days in March, when Facebook was looking like it was trending towards $100 a share, if you would have just sort of kept that thought in mind, that would have given you the courage to pull the trigger and now have doubled your money in a short period of time. So I think, as seductive as the short term can be, a long term focused or even just medium term focused is definitely going to serve you better longer term.
All right, great. Very good advice. So lately I've been asking our speakers to talk about things they've learned over their careers. I'll do the same with you two guys today. As you look back, what was something that you view as important that you learned that you actually would have benefited from learning sooner?
You want me to go
Thomas.
first? Yeah, I mean, kind of in the whole, we're talking about investing, we're talking about long-term returns. I mean, that all kind of comes down to compounding, compounding the asset you have over a period of time. And I think, the thing that I didn't appreciate when I was younger is I didn't have a lot of money, but I had a lot of time and I had a lot of energy, and just, I was really the wealthier man in the room just simply because of that ability to compound my time and career, even though at that time it didn't look like I had much because I didn't have much money, but that was really the least valuable of the assets of that one has in their life. And I think people really underappreciate, what they can get done in 20 or 30 years of a career.
And maybe kick off your career by working with me, right?
Yeah, absolutely.
Patrick.
I would say I think the one thing I wished I would have learned earlier in my career is it doesn't matter what your job is, what your role is. At the core of everything, we're all salespeople, and you have to sell yourself. You have to sell your company. And I think within the investing world, sometimes you think, well, my numbers will speak for themselves. And as you progress during your career, you realize that for 99.9% of the people, they don't. And you need to sell yourself, and you need to always remember that no matter the business, it all comes down to sales, and to do that in a way that you feel comfortable with and that reflects you.
Okay. All right. Well, guys, it's been a pleasure. Thank you both for joining us, Thomas, Patrick. Again, if folks want their contact information, you can get that in the comments field. Hit the subscribe and like button, hashtag investing if you want to go in the drawing for Clancy's Meats and Fish. Again, gentlemen, thank you very much for joining us, and look forward to talking again.
Thank you very much.
Thank you, and all the best fishing this afternoon.
All right. Thank you.